In this video, we're going to examine the taxation of profits from trading futures. In particular, we're going to look at how taxation is different for hedgers versus speculators. Our example for this video will be futures trading in the live cattle futures contract. This is a graph of the spot price of cattle from around 1960 to today. You can see it has gone up significantly, quoted in cents per pounds, to something like 10 cents a pound in the 60s, peaking at around 170 cents per pound in 2014. It has since came back down to a low of around 80 cents per pound, and then in recent years gone back up. It is going back up significantly now in 2021 as there is significant inflation in the U.S. economy. Who would be worried about this type of inflation? Well, those of us going to the grocery store who like steak, but also particular, we can look at the example of the owner of a chain of steakhouses is worried that increases in cattle prices will negatively affect his profits. We could also have somebody trying to make money off this increase in prices. A speculator believes cattle prices are going to increase significantly during the next year. Both of these parties could take identical position in the live cattle futures market. In our example, both will take out 3 long positions in the live cattle futures market for June 2022 delivery, and they're doing this in December of 2021, in particular on December 10th. Each of these 3 contracts covers 40,000 pounds of cattle, and they sign the contract for delivery in June of 2022 at a price of 137.375 cents per pound. So let's say hypothetically on the last day of December of 2021, this same futures contract trades for 140 cents per pound, and then on the delivery date in June of 2022, the spot price, which is the same as the futures price then for the live cattle, is 150 cents per pound. And we ask first, what is the total profit for each investor if they hold the contracts until expiration? Well, the profit is going to be 3 contracts times 40,000 pounds per contract, times the final price, 150 cents per pound, minus the initial price, 137.375 cents per pound. And again, that will first give us a quote in cents, 1,515,000 cents, but that's $15,150,000. And this is the profit to both our hedger and our speculator. But the 2 parties will be taxed differently. The hedger will be taxed on this entire amount in 2022, the same time they purchase the cattle. The speculator, on the other hand, will be taxed partially in each year. So the profit to the speculator in 2021 will be taxed in 2021, and that profit is 140 cents per pound minus 137.375 cents per pound. The price of the contract on December 31st minus the price the speculator entered into the contract times the 40,000 pounds per contract times the 3 contracts gives a profit in 2021 of $3,150 for the speculator that will be taxed in that year. The remaining profit, the contract continues to go up from 140 cents per pound on January 1st to 150 cents per pound on the date of expiration of the contract for a further profit of 10 cents per pound times 40,000 pounds times 3 contracts gives a profit in 2022 of $12,000, which will then be taxed in 2022. The sum of these two, 12,000 plus 3,150, is again the 15,150, but all of this is taxed in 2022 for the hedger, and it is split up, so 3,150 is taxed in 2021 for the speculator, and 12,000 is taxed in 2022 for the speculator. All of our data came from CME Group, which also provided this nice graph to us, and I thank you for watching this video.